David, we're delighted to have you here. I have to start with the obvious question. The London Stock Exchange is 75% of your company name. It's not 75% of what you do. What's the CEO of LSEG doing at a session called the Data Imperative?
Well, Andrew, thank you for having me here. London Stock Exchange Group, yes, people of course think of the London Stock Exchange as a great part of our business. It's been around for 300 years, one of the world's iconic financial brands. And yes, it's about 3% of our revenues. Most of what we do is data. We're one of the world's leading providers of financial data and analytics. And then we do have equity trading, fixed income trading, FX trading, and probably the world's most systemic clearinghouse. So financial markets infrastructure and data.
All right, we've established your data bona fides. Before we get into that data story, we last met 3 months ago in Davos when you told me that your scenario planning for 2025 presumed a lot of volatility. This is a man who got the Davos non-consensus right. How has what you've seen in the past 3 months changed what you're expecting in the financial markets part of the business for the rest of the year?
Well, it hasn't changed it a lot, actually. And when we spoke a few months ago, I think I talked about the fact that we're not in the prediction business, we're in the scenario planning business. And we do that, our business is global, so we look at situations, risks, opportunities all over the world, across asset classes, across markets. And I think if you look today at the global situation, you have a lot of the same issues and a lot of the same risks that we could have talked about 3 months ago. A number of them have played out in a way that was very different from, I'll say, the consensus in January. But they're, I think, in the context of all of the geopolitical activity, in the context of the discussions around tariffs, in the context of inflation, in the context of the bond market. We look at all of those different levers and many, many more, and we never get it completely right. But it's helpful to try to be prepared for what could be coming.
Are you having to entertain scenarios now that you weren't 3 months ago?
Yes. I think the range of the possible has broadened,
What sort of thing are you now?
Well, there was an interesting article in one of the risk publications the other day talking about the fact that European banks do 17% of their funding in dollars. And raising the question as to whether, if there is an escalation of tensions between, for example, the EU and the US, does it become problematic in some way for EU financial institutions to lend money in dollars?
Right.
That's not something that we thought about a few months ago. So again, I'm certainly not predicting that. That's in that long tail, but things like that are now on the radar screen that I think our industry needs to think about.
So getting back to the data theme, you came into LSEG in 2018. Mm-hmm. What was the data opportunity you saw within it?
Well, at that point, LSEG was a largely European-focused, equities-focused market infrastructure, mostly the exchange, and had a very niche data business. Very small, largely focused on fixed income analytics. And the view that we had was the role of data in financial markets is just as important an element of market infrastructure, if I can use that phrase, as is access to the liquidity on an exchange or the risk management in a clearinghouse or any of the other structural elements of the financial sector. Having access to the data and the data itself. You cannot participate in the markets without that. So the vision was to make sure that we were not a niche player in this space, but one of the world's leading providers of data and analytics. We also thought it would be important to broaden our asset class capability and broaden our geographic scope beyond Europe.
So you bought Refinitiv as part of this strategy, but big picture, what do you feel were the most important moves you took to establish this as a business with data at the core?
Well, the acquisition of Refinitiv was a very large part of that. This was the former Thomson Reuters finance and risk business. And again, that took us from being a relatively small player to, in that acquisition, becoming one of the world's leading providers of financial data. We're the number one provider in the world of, for example, real-time data. And so that was the big step, but we have done a number of smaller transactions since then. We have invested an enormous amount in improving our data machine, if I can call it that, and that includes functionality with AI, to touch on another topic. We have also struck a number of partnerships, and so it's been a significant journey over the last 4 or 5 years.
So probably the biggest or highest profile of those was a partnership with Microsoft on,
Yes.
on AI. You did this back in late 2022, and I think a lot of CEOs were still trying to figure out, they were just playing with this, if that. What has that partnership given you so far?
Well, the way you described it there, it makes it sound as if we had great foresight on AI. I would not make that claim. We did spend a lot of time with Microsoft for about a year and a half before that, and it was about bringing together their technology capabilities and their global distribution and workflow. We all use Microsoft capabilities in our work, unless you are an unusual or have unusual workflow, and really future-proofing us for that. But that combination of their technology, their functionality, their cloud capacity, with our data, with our analytics, we saw as a very, I think, I don't want to speak for them, but obviously we did this partnership together. We collectively saw as a very attractive way to accelerate what we are doing and what they are doing for the financial sector.
Would you advise people who are trying to figure out the kind of AI future of their data that partnerships with the biggest players in AI are the way to go? There's always a tension there between how much you're surrendering in a partnership.
I think that's a very interesting question. And just to be clear, with respect to our partnership with Microsoft, this is a big, important partnership to us. Microsoft took a 4% stake in us. Scott Guthrie, who is Microsoft's head of cloud and AI, joined our board. And within that construct, we are not exclusive with Microsoft, and they're not exclusive with us. We have what is called a poly-cloud policy. And we work closely.
Sounds like something much more exciting, but yes,
okay. Some people use multi-cloud, some people use poly-cloud. And it's really important to us, but also more important to our customers, that we are serving our customers where they want to be served. So we would never be in a position or put our customers in a position where we would say to them, you have to use a certain cloud provider to access our data.
Right.
We make it available in the way that our customers want to access it.
So what's your favorite example of what this AI enablement has done for LSEG?
I have a number of examples. It goes from what I would almost call now relatively mundane, which is a striking thing to say given how quickly the AI dynamics have shifted. But I would say a lot of companies use AI for customer service now. We have about 2,200 people responding to hundreds of thousands of customer queries, given the massive data that we have, the complexity of some of our analytics. And we have basically created an internal model, large language model, that serves those 2,200 customer service agents with all of our internal documentation in the model. It's made them 50% more efficient.
Right.
And I would expect over the course of the next year or so, we will just expose that internal model directly to our customers. That's an example. I could give you a number of others.
So you're not just dealing with any old data here. This is critical data. People have to be able to trust it. Famously, AI models we worry about hallucinations. What have you had to do to ensure that the data feeding these models is high quality and that what you're getting out of them is as trustworthy as it needs to be?
So this is a critical question for our sector and our customers. And if you look at the accuracy rates of the various models that are out there, they can range from 5 or 10% hallucination rate to, in some cases, much higher. And they've been improving as the technology has been improving. But a 5% hallucination rate in the financial sector is not acceptable. Imagine if an analyst's work was 95% accurate. You're going to be investing billions of dollars on that basis? Absolutely not. So it's mission critical for us, literally, to have validated, verified data that we can provide to inform our customers' models, that they know where that data is coming from. They can basically, it's like having a footnote on every piece of data. And again, a lot of the publicly available models are working and moving in this direction, but a lot of those models are trained on the internet. And there's a lot of good information on the internet, and there's a lot of inaccurate information on the internet. So we train our models based entirely on data that we can validate and verify.
So it's kind of closed circuit.
Yeah.
Right. There are also huge debates about data sovereignty. Nations putting parameters around where data can be stored. To what extent are you running into those barriers? And how tricky is that making the sort of digital economy? And should we be worrying as much about the flow of data right now as we are about the free flow of physical goods?
So we should be worrying about it, and there's a lot of attention on chips and cars and steel and various other goods, and there's less focus on the free flow of data. But data plays a critical role in global economy and in growth rates. There are, of course, privacy reasons and national security reasons why countries should have a certain element of control over their data. But what is important is to find a balance between those privacy and national security issues and the ability to have free flow of data across borders in a way that serves growth, serves AI, and can be helpful to the economies. Actually, this is a very interesting, I'll say, counter-example to the current narrative around tariffs in the US. In the first Trump administration in 2019, the renegotiation of the USMCA included a very forward-looking digital trade agreement. And the Trump administration also signed a free digital trade agreement with Japan. And so I think we'll see how that plays out in this Trump administration.
But you're hopeful for...
But I think there is meaningful opportunity there. And that's in contrast with what you have seen in some other countries where data sovereignty has been more restrictive. In India, China, France, for example, have all taken very different approaches to that.
So let's end on a global markets question. People have been fretting for some years now about the preeminence, the dominance of US markets and of half a dozen, Mag 7 stocks within those markets. Do you think the upheavals of recent weeks fundamentally have any lasting impact on the preeminence of the US and the global markets?
I think what we have seen over the last few weeks is, you used the word upheaval, I think of it more as a rebalancing.
Right.
And when we last spoke in January, I think the US as a percentage of global market cap was 70% or higher. It's still pretty far up there, and that feels overweight.
You're saying it has a long way to fall?
I think, again, this is not a prediction, but I think it would not be unusual for there to be much more of a rebalancing in terms of allocation of capital in the equity markets. You could say the same thing about the value of the dollar. So there's been a lot of discussion about how the dollar's value has gone down, 9 or 10% in the last couple months. There's a good case to be made, and again, I am not an economist, this is not a forecast, but there is a good case to be made that the dollar is 20% or so overvalued today.
Okay, it's not a prediction, but we'll hold it to you. Hold you to it when we see you next. So, David, thank you very much.
Thank you very much.